Hello everyone, welcome once again to Week 10 learning videos. In this learning objective, we describe how a managed fund, which is also known as mutual funds, operate and analyze some evidence on the relative performance of the active versus passive managed funds. Managed funds are professionally managed investment vehicles that pool money that's collected from several different investors and they invest that pool capital. So when investing the pool capital, they use a predetermined investment mandate. This mandate is the rules that govern the investment strategy. The professional fund managers who are responsible for investing will go about investing the collective pools of assets across various asset classes such as equity, fixed income, or cash according to the mandate of the funds. So, from the perspective of an individual retail investor, the idea of managed fund can be significantly beneficial as it enables them to gain exposure to various asset classes that were traditionally only available to institutional investors. Individual investors can also gain an additional diversification across assets that might be possible if they had only directly invested their own money. So we know that most mutual funds or managed funds adopt a unit trust structure. It means that when you invest your money, it's moved into the fund and units are created and issued to you in return of the money that you invested. The fund continues to issue new units to new investors and existing investors as long as it's open-ended in its structure, whereas a closed-end fund, as we saw in the previous video, will only have an initial public offering where they will initially issue shares and they won't issue or redeem any subsequent shares from that point forward. We call the value of each unit the unit price, and the investor is entitled to a pro rata proportion of the residual cash flows of the funds according to the number of units they hold. For example, let's say a particular fund has 1,000 units on issue and you own 100 of those units. Now you are entitled to get 10% of all the profits generated by that fund. The unit price itself is generally a reflection of the value of the fund, although if it's a unit that's listed in stock market, some market forces can also affect the price. And when we talk about the value of the fund, we basically talk about the net asset value. Net asset value is the market value of the assets that comprise the fund. Net asset value is calculated on daily basis, and where redemption is possible, the redemption happens at the net asset value, usually at the end of each day. Now, when managed funds invest money, they earn money in the form of dividends, interest, realized capital gains, and all this money is made available to unit holders. Fund managers are actually obliged to distribute this income to investors in the form of various distributions, where the frequency of distributions may differ. It can be monthly, quarterly, semi-annually, or annually, and the investors themselves has the choice to receive the distribution as a cash or to invest the pack within the fund. Now, when the fund goes about investing with respect to their mandate, there are two key different ways that they can invest. That means there are two different types of managed funds. One is index fund, another is actively managed funds. Index fund is passively managed and the underlying portfolio will be constructed such that it follows some particular benchmark, whereas actively managed funds seek to take advantage of the expertise of the professional fund manager, use security selection and market timing in order to outperform the market. Now, starting with index funds, the idea of index fund is to achieve the maximum possible diversification with lower transaction costs. So given there is no active management, we are able to reduce the fees associated with trading, and it gives investors an opportunity to invest in some representative basket of stocks. The most common form of index fund will be a market index fund, which tracks a market index, and this is the way that investors can earn the return that's equivalent to the return on the market as a whole. The performance of this fund is determined purely by the asset class because these funds don't attempt to generate alpha. So it's return not due to the performance of the portfolio manager per se. The return should just be directly linked to the underlying assets. In contrast, an active fund uses a team of professional managers and their ability to generate high returns. So while the return is in some way still linked to the performance of the underlying asset classes, there should be some alpha which is either going to be positive or negative based on whether the active investment was able to either over or underperform. Now, obviously, we know that when you have an active fund, there is going to be significantly higher transaction costs, the cost that you pay for buying and selling shares. There is also a management fee, which is to compensate the professional fund manager for their time, their administrative expenses, and so forth. And this can be around 1% per annum. Given that there are these two types of funds, an important final question is which is better? Evidence shows that passive funds actually tend to outperform active funds, and there is a reason for this. The reason is that markets are relatively efficient, and it's difficult for an active fund to earn an alpha that's greater than the fees that the funds charge. So basically, we find that before transaction costs and management fees, active funds are able to generate a relatively small positive outcome. But because that the magnitude of that alpha is smaller than the cost incurred by the investors in the form of transaction costs and management fee, the net result is a decrease in wealth or a negative performance. So most studies would suggest that passive funds outperform active funds. That's all of our discussion on learning objective 2. Thank you.